Well, I've always loved startups. And even as a banker, I was lucky in that I got to invest in new and rapidly growing companies. I love working with entrepreneurs, helping them strategize around issues related to growth, and then being part of their success.
I've been an investor and had my own venture fund for probably 20 years now. But I was a trial lawyer for 10 years, and then I became an entrepreneur in 1980 and ran a bunch of my own businesses and developed them over a number of years. And then I think we started our first venture fund in 1990 and have continued to invest personally and with groups and through the fund for the last 20 years or so.
And today we have a 50,000 square foot place in the Merchandise Mart where over 200 startups are members.
When I was spending time at Google in Chicago for about 10 years, really got engaged in kind of the startup world and helping to advise a lot of early stage startups who were hoping to, I guess, get some perspective from my experience at Google as they built up their digital startups. And when you're mentoring them, sometimes they invite you to invest, and a few times I started to invest, and then I got involved in High Park Angels. It's affiliated with the Booth School, where I went to grad school, and so a number of things got me into investing in early stage companies, and I like to do it, one, because I like to help out the companies, two, because I hope to make a nice return from the whole thing, and three, I guess, because hopefully I can pick them, but that hasn't been determined yet.
Went to liberal arts, ended up on Wall Street doing finance, went to business school at Kellogg, and then came back out of there and I thought I'd go into buyouts. I figured that was what I was going to do. I had a master's in manufacturing in addition to an MBA, and life doesn't always go the way you planned, which is, I think, the heart of venture capital.
We'll convince a company to take money for the first time, and we help them grow and get positioned so that they can go out and raise a significantly larger round. And I think roughly 10% of our companies have gone on to raise 10 million plus in the round immediately following ours, so that's something we're really proud of.
We invest in digital IT media companies. We have a business and financial services team, which looks at a lot of web-based B2B oriented solutions. We have a healthcare life sciences team, and we have a device company in the portfolio right now and are looking to expand that. And then we also invest in consumer. And to us, that's everything from brand new products to web-based solutions to multi-site consumer service businesses, including retail and restaurants.
One of the areas that Chicago is very strong in is, yes, interactive media and e-commerce. You look at the Peapods, the Orbits, etc. Those are all phenomenally successful stories here. And they've spawned off companies as well. But if you look at some of the really interesting ones, they're all in the B2B. A lot of them are in the B2B space, where you're taking new technology, applying it to an old problem. It's a gritty domain problem, and then building extremely sizable, large businesses that often go public.
About 20 to 25 angel investments that I've made. Most of them have been digital startups. I'm an investor in a couple of restaurants. One of them is GT Fish and Oyster in River North, which has done well, but mainly I've stuck to things that I know pretty well.
The things that I was interested in, which had a concentration in the space between social media and technology, were how much personalized information was going to be readily available, how much accountability and measurement was going to be part of driving the marketing equation, how constant connectivity was going to make information available to everyone in new ways, and then lastly, how behaviors were going to be driven in new ways, particularly because of the impact of social sharing and status.
2012, I think in the startup world there's been more early stage and seed capital available than ever before. I kind of joke that people can raise a couple $100,000 with an idea on a napkin, but that's been really good. And this is specific to Chicago. Chicago's really grown a nice group of angel investors and both some venture firms that have come down and done early stage investments, as well as things like the Firestarter Fund and the angel groups and all this. So we have a really nice group of early stage investors. And so that's been a good trend because you need that startup capital. And what's neat about startups today is that they're super capital efficient. They have a short runway to really knowing if something's going to work or not.
We are looking at about 100 deals a quarter at this point, and our pipeline continues to stay very, very strong. We actually invested in 7 new deals last year, which is a record for us. 5 of those actually were in the last quarter. And in addition to that, we supported 6 existing portfolio companies with follow-on investments. So it was a very, very busy year.
I think the larger themes were generally that on the consumer side, consumers were more and more willing to move their offline activities online. And that's been happening over a series of years. But 2012 in general, I think was really interesting because the speed at which people were moving and the growth of the companies, that was a reflection of that. You see, for the first time, companies moving from $0 to $100 million in revenue in under a year. And seeing that rapid expansion, I think, was really telling in terms of where consumer trends are going.
Companies like Local Offer Network, a good company that's basically engaged in technology that permits the first time you come to a site to offer you personalized information that's appropriate to you. Kumbaya.com, which is about tribes and the idea that there's a great deal of conversation going on, but how do bloggers and writers and people who are aggregating important constituencies, how do they monetize that? How do they turn that into something of value? So we're seeing all kinds of things in the education technology space, but also more, we're seeing a migration to how to identify and help colleges and educational institutions of all kinds attract, qualify, and secure students.
We also recently invested in a consumer solution called Retrofit, which is a deal that was led by a great West Coast firm, Draper Fisher. And Retrofit is an online, data-driven weight loss solution that combines high-tech and high-touch and is getting just terrific results out there with participants who want to lose 10 to 15% of their body weight.
We invested in a gaming company out of Omaha, Nebraska called Skyblue Entertainment, and they created a franchise called the Battle Bears, which is an iPad-based game targeting kids 9 to 12. They're profitable, they're doing a multi-million-dollar run rate, and they just signed a deal for a television show leveraging their property. So, that's one of the areas that we're really interested in. We also did a seed investment in a company called WalkBy, which is a local Chicago company here. The entrepreneur was a guy named Josh Hernandez, who was the founder of TapMe, which was sold to an ad agency. So he just came aboard the Lightning family, and we're really excited about what he's up to as well.
We're now focusing on people's interests, not simply who they are. That's already a given. So the interest graph is very critical. Number 2 is high velocity computing is permitting marketing and selling to change so that the instant that we are in the marketplace, information is provided to us in ways that's highly customized, highly personalized. And again, it's information that's there on demand, but we don't even have to ask for it. It's really sort of an interesting new equation where offers will be provided to us, information will be provided to us based on our location, on our interest, on our preferences, and in ways that are very exciting.
We're looking at a number of different sorts of opportunities, including some that have what I guess I call traditional IP around them. So patentable types of products, and that's exciting. We see those types of opportunities coming out of, for example, our universities, out of the R&D efforts there. Our healthcare group is very active at the moment, and again, they're seeing opportunities in in sectors like devices, which are not traditionally true angel type sectors, but we're seeing some, some opportunities there that are very accessible to us.
I think the mobile side is going to continue to propagate and continue to be really huge. I think I saw a stat that in the third and fourth quarter, more iPads were sold than all PCs combined. So I think that trend is continuing, and I think the usage behavior for consumers is increasingly moving to the mobile side. And I think the interesting facet of that is the user, basically since iTunes was introduced, is much more used to paying for content. And I think you're going to see a kind of a shift from a large ad-based kind of business model on the online side to a much more consumer transaction and an enterprise-driven transaction business on the mobile side, and we're excited about that.
So the Series A crunch, really is that there's all these startups, that have raised a small amount of capital, like that seed round, angel round, usually $500,000 or less, and they're all doing great things, hopefully, but a lot of them are going to come back to their investors over the next year and say, hey, I need to, this is what I've done, I want to raise more money. And a lot of times that'll be a multi-million-dollar round. Hopefully, that'll be a good problem to have. But the question is there enough capital to go around? Are there enough?
The VCs now are starting to pull back. You're starting to see fewer of these late round deals getting done. You're starting to see them start to kind of retrench a little bit. About 2013, there's going to be a reckoning in terms of the deals that have been done. And those that have focused on the customer value proposition, have a revenue model, are controlling their burn, and have syndicates with deep pockets, will do well.